Mr. Rana Kapoor, MD and CEO of Yes Bank, joining in. Lata's also in the studios to talk about some restructuring at the bank. Lata?
Thanks a lot for that, Surbi. And good afternoon to you, Mr. Kapoor. Thank you very much for joining us. We've just got this press release that you are planning to deepen your retail and business banking. And to that end, there has been a restructuring. Can you take us through what exactly you have restructured in the bank?
Well, Lata, this is organizational, restructuring to add more laser focus to our retail banking initiatives. As you know, that more recently we have accelerated our, retail SME business banking platforms under the leadership of Pralay Madam, who joined us about a year ago. And we are seeing critical momentum building up in these businesses. We have invested in leadership, almost 9,000 out of our total 12,000 plus Yes bankers are now deployed in retail banking businesses. And they are fairly well now regionalized across the country. Naturally, our emphasis is also to build granular liabilities, bring in more CASA, as well as augment our retail assets, SME, businesses under Pralay's leadership.
Okay. Well, actually, you are stepping into the retail space, or rather deepening your presence, primarily at a time when competition has gotten really hotter, Mr. Kapoor. Yesterday, we had HDFC Bank cutting its base rate to 930 actually. Do we see a similar action from you?
It's a little bit early for us because we believe that there is still a risk and reward ratio wherein we can maintain rates for a while. But in the medium term, give or take the next 90 days or so, we too see further reduction in interest rates. We are seeing a shift already happening on the deposit side with the long-term deposit rates hovering at 8% and below, which is a reduction of almost 1.5% compared to 1 year ago. And therefore, I think the overall conditions, market conditions, are indeed favorable for further transmission of lower rates in the economy, naturally starting with deposit rates and gradually moving towards lending rates as well.
Yeah, Mr. Kapoor, but you all stand at 10.5 as base rates? That's quite a distance, isn't it, to be an effective retail competitor?
Well, we are not exactly today a consumer lending bank,
Yes.
We are predominantly a liabilities-seeking banking institution, which has a very competitive rate on a savings proposition of 7%, the cut-off balances. So that's our single biggest thrust area as far as retail banking is concerned. On the asset side, our predominant focus today is micro SME lending. And in that business, 10.5% is very competitive pricing. And we are, as I mentioned to you, will be relooking at our rates. We did reduce 0.25% about 2 months ago. And there is a case building up for further reductions. I do expect that to happen possibly in from October onwards.
Okay. You said that you're largely a SME and MSME lender. Do you see any stress in those sectors? When we last spoke with Mrs. Bhattacharya, the chairman of State Bank of India, she was saying that stress is reducing in the large corporates and mid-corporates, but it has not reduced in the SME segment of the economy. How is the experience at your end?
It's very interesting that, the SME and micro SME has got typically a new lease of life, because the e-commerce boom in our country is engaging a lot more with the SMEs and micro SMEs. And you find that the sellers, for example, in Snapdeal has 200,000 sellers. They're predominantly SME businesses, which are seeing their margins improve because of the, intermediation of e-commerce, reducing the overall supply chain impact. So they are literally going to from their production shops. They're going to the consumers. So SMEs which are engaged with marketplaces with e-commerce, that is the very interesting segment banks like ours, which is reasonably digitized to focus on. So we are actually building segmented strategies, not run-of-the-mill strategy.
Okay, can you just give us the breakup? How much are you exposed to large sector? How much to mid-cap? How much to SME? And how much to retail? And how will these percentages look, say, a year down the line when you may have deepened retail?
Lata, as you know, for our June quarter, we are approximately 35% in retail banking and SME banking. And within that, SME banking is around 20%. So that's the lion's share of our branch banking businesses. The retail is growing for LAP products. We are steadily going to introduce credit cards, affordable housing finance, mortgages, and our product suite is getting fairly comprehensive now for us to evolve as a meaningful retail bank. So in a year's time, probably see this SME and retail composition go up to maybe about 35%. But our target for 2020, so we are in the third cycle phase of the bank. Our projection is to bring our retail businesses, the entire composite, to about 45% of sources goods. Our single biggest, business in its entirety by 2020.
But that, that's coming at a time when you perhaps have a lower number of branches than most other banks. I mean, Kotak started with you, but with ING Vaishya, their number of branches is vastly more than yours. And then now you have this huge competition from deep-pocketed conglomerates who have got payment bank licenses. Will not this become tough? And more importantly, will this not come at an expense on margins, your retail thrust?
See, Lata, basically, if you analyze branches, there are 53 cities in the country which have a population of more than a million people. There are 465 cities which have a population of between 100,000 to a million people. These are cities which are still very starved of banking products. There is a lot more, I would say, inclusion required for these cities. As part of the urbanization plan, for example, the government, the Prime Minister.
Would you be tying up or trying to buy up any bank, Mr. Kapoor? Any inorganic moves from you anytime soon?
We are as a relatively young bank. Our biggest strength is execution of our focused strategies. So what we can do best is to execute with quality filters, the proper focus on segmented industry, sectors, and most of all to build consistent quality of HR, which in the business of banking is a hugely important investment. So yes, we may buy portfolios. Foreign banks are compressing. Opportunity to buy, portfolios. We may look at some stage buying portfolios even from seats as they create, more volume. So we have a slightly different strategy because the strength of our management team is to really build, businesses from the inside in.
Okay, Mr. Kapoor, as head of ASSOCHAM, you have a bird's eye view of Indian industry as well. And as you say, you are only 35% in SME and retail, and the larger part of your book, 65%, is with large corporates and mid-caps. There was recently that UBS report which was saying that you have a larger exposure to infrastructure and probably commodity-related companies. Do you see any stress at all developing in this? I mean, just because you have lent to them doesn't mean they have to be stressed loans, but do you see any stress developing?
We have discussed this issue, Lata, when I came to your studio last as well. The fact of the matter is
things have gotten worse, Mr. Kapoor. Things have gotten worse. I mean, the amount of steel dumping and then the 5% Chinese devaluation. You stand at a vantage point and you will be able to tell us whether the infra and particularly the commodity sectors, the core sectors including steel and cement, are going through greater stress now. in the last 1.5 months?
You see, iron and steel, I quite agree with you, is going through a lean patch. But, infrastructure and infrastructure adjacent sectors, including cement, are not doing so badly. I think the economy has been rebalanced over the last 12 months. There are improvements in the risk profile of many of the large and mid corporates. Many of them are raising capital, plus, disinvesting non-core assets. I think the overall de-risking of the economy is substantially underway. 2 years ago, I would have been more concerned. But now, towards, the third quarter of 2015, I would say that, overall, systemic risks have come down and the overall situation is much better. Because if you compare 2015, the same period, to 2013, all macro indicators, without exception, are all significantly better than the same quarter, July, August 2013. You'll remember that period not very long ago.
Yes.
All fiscal indicators, without exception, are much better 2 years later. The only thing that needs to accelerate further is the reform expectations in the economy. And I think, that's one big issue. If that gets going, we are looking at a 7.5% to 8% GDP in our country pretty soon.
No, it's reassuring coming from you, since you both, as the head of a Chamber of Commerce and as a bank, would be better placed to put your finger on the pulse of these large industries. I understand you have a 3% exposure to steel. Do you see steel sector having seen the worst, or can it even get worse?
You see, the 3% we have is basically there are only two credits, which, given our size, are small to medium-sized credits, which are fairly well collateralized. The rest of our steel exposure is in the form of bonds to AA plus, AAA rated steel companies. And my colleague Rajat Monga is also on record on your channel just a few weeks ago on this particular item.
So you wouldn't worry about these companies?
In the sense that, these are, end of the day, as long as there is preservation of economic value, which means these assets are very difficult to replicate. The help they need is, 5 by 25, which is going to reorganize their cash flows over longer tenures. But there should be a fair amount of collateral to loan value embedded in these assets. Once there is an improvement in the, cycle, the growth cycle in the economy, let's say 12, 18 months with some lag effect, these companies will bounce back.
That's very positive to hear from a person who would know this industry well. Mr. Kapoor, let me...
of patience,
Of course. No, there is that with infrastructure industries. Mr. Kapoor, to just end where we began, in your retail thrust, would you say that, given that you are in that you have decided to deepen your retail presence both on the asset and the liability side, but considering that it is coming at a time when competition is really hotting up because of payment banks, because of new small bank licenses that are going to be announced sometime this month, and because of increased retail thrust from the public sector banks themselves, should we expect that Yes Bank's margins a year down the line or 24 months down the line is definitely going to be trimmed compared to your current margins?
Lata, we set up a bank 11 years ago, and last week was our 11th anniversary.
Congratulations.
We have worked on average 12 to 15 hours a day over the last 11 years. And we have grown at a CAGR in excess of 35% in an 11-year period. Amazingly, despite that, we only have 1% market share. So the point is that Yes Bank, which has toiled over the last 11 years, has acquired only 1% market share. So new banks are welcome because, end of the day, the entire inclusion brings in a lot of symbiotic flows into the system. And therefore, banks will also gain, all kinds of banks. But, these investments in new payment banks will take a long time because they have a very long gestation to it. We are already a payments bank. We already are a small bank, because the nature of our business encompasses all of this. So it's not like this is going to be like a very fierce competition. On the contrary, there will be synergies that, we will capture with payment banks. Most definitely so.
Okay. All right. We leave it at
and
that.
My portfolio, small banks,
Okay. No, I take your point, Mr. Kapoor. It's just that markets have suddenly taken a turn for the worse. We have to attend to them. Thank you very much for joining me. Well,
sure.
This is not looking like a good picture at all as far as the bank Nifty is concerned, Surbhi.
Yeah, absolutely, Lata. I was actually, while you were having that conversation, I was looking at a couple of stocks.